Good morning and welcome to the Post-Monetary Policy Committee press briefing. As is usual, we have this press briefing after the Monetary Policy Committee meeting, which took place yesterday, the 23rd of November 2022. As we usually do, we'll have the Governor of the Central Bank of Kenya addressing you, making his statement, and after that, we'll be able to take your questions. For you to get your questions through, please put them through Slido. That's www.slido.com. The meeting today is hashtag MPC 1122. Hashtag MPC 1122. Without further ado, I'd like to welcome and introduce the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Good morning and welcome to this briefing following the MPC meeting that was concluded yesterday. You'll already have seen the press release that was issued yesterday. So this meeting, I'll provide you additional background information to give you the context, the underpinnings of the decision. And I'll start, as we usually do, with the global developments. Since our last meeting in September, policymakers in the advanced economies have reaffirmed their resolve to address the inflation problem in their economies. And they have redoubled their efforts. So far, they have been hiking rates aggressively and also communicated their objectives quite loudly and quite clearly. And also indicated their future actions. So inflation still remains in advanced economies remains high. We are trying to get okay, there's the slide. And has breached 10% in some of the economies, as you can see, in the UK and indeed in the Eurozone. And it's true, the US the US rate has come down marginally to 7.7. So the problem still remains. Secondly, the growth outlook has weakened. And here's a chart that relates to or is from the IMF. This is the World Economic Outlook numbers, projections that were done last October. And you can see relative to, say, the projections that were done in January, global growth has been scaled back by about 1.2 percentage points for 2022. And indeed, about the same magnitude, 1.1% percentage points in 2023. Interestingly, of course, is the sub-Saharan Africa, which having scaled back by about 0.1% in 2022. But I think the East African region has been actually stronger than was expected, but still ended up, at least for Kenya, scaling back the growth by a marginal amount, which we will discuss a little later. So that is the context, the advanced economy, the problem of inflation in advanced economies. The point also is that the markets have been quite unsettled, jittery, volatile, with small bits of information leading to huge swings in the outcomes. So for instance, in the last year's CPI data that was sent out, 7.7, it was better than was expected, and this led to significant movement in both equities, in the financial markets, and indeed even on the exchange rate, the US dollar rate relative to the advanced economies that fell by some amount. So there has been a lot of seesawing, pushing and pulling, as it were, between the fundamentals and the perceptions. By the way, these are not two different soccer teams. They are just various drivers of let's say, the outcomes in the financial markets. And bottom line is there has been increased fragility of the financial markets, which all of us have to deal with. There are 2 points I'd want to make. First, the very strong spillovers of policy actions by the advanced economies to the emerging market and developing economies. So this has been through, for instance, the channels through, for instance, the strong dollar, through the fragile markets, etc. But this is expected to have spillbacks into the advanced economies, and it appears that now the authorities in those economies, the advanced economies, are beginning to consider the spillbacks, and therefore the implications of the spillovers of their policies into the emerging market and developing economies. The second point I would want to underscore is let's just call it inescapable laws of economics, meaning things have to follow the laws as we understand them, as we study them, etc. And I think the best example here, a good, bad example, is the UK experiment in September, October, in terms of the policies that were put on the table, which in the end were seen as weak at best, and let's say also destabilizing as they did. So I think the point here is not so much to look at the specific policies, but to remind ourselves that, yeah, there are inescapable laws of economics that we have to understand how the markets operate, etc. Another point I would want to raise, still in the global space, is the international crude oil prices. And here, as you can see, this is a chart that shows our benchmark oil, Marban oil. There are other benchmarks, and this is the one we have here in the country. And you can see that the average so far has been $106 per barrel. The price now is lower than that. It's at 86.4. Actually, this morning it is a bit higher than what is shown here. But the point is that it has, as before, it was volatile, and now it's settling in the 80 to 100 region, or around 90. So this is something, obviously, that we have zero control over, and we have been making the point that it actually will drive our outcomes, both on inflation, etc. Finally, global commodity prices also, and the supply chain issues or pressures continue to ease from their recent peaks. This is a rather busy chart, but one that I think I like, and definitely I'm sure you'd like. And the point is, it shows for most of these products, the peak was in Q2 of the year, so around April, May. So for instance, palm oil price, you can see it went up to $1,717 per metric ton, and now it is south of half of that. Yeah, so it's now in October it was 889, and I think the point here is that the increases that were there were driven by other factors that have nothing to do with us. They're specific to those markets where we are buying from. And I think we do understand some of the factors, the Ukrainian war, but I think war farther than just that particular driver. So we obviously expect to benefit from these declines as the prices settle to maybe more normal range of those prices. There's another slide as well on related to the supply chain challenges. This is the cost of an index related to the cost of a 40-foot container, transporting it around. I don't remember how it is defined, but I think this is something that is available in the various sources. And you can see it was up to $11,000, and now it's closer to $3,500. So again, also significant decline from the peaks that we saw in September of 2021, even as we appreciate that this is still away from where it used to be, around $1,500, $1,700 per barrel, back in the before the crisis of the COVID crisis, etc. So that's what I want to say about the conjuncture related to the global economy. And so we switch now to the domestic economy. And in May 2022, we warned about the possibility of breaching our 7.5% threshold on inflation over the next few months. And in fact, since June, the outcomes have been higher than 7.5. And now that also we have actually acted and actually adjusted policy rates in May, September, and indeed just recently, yesterday in November. You know that. But I think it is important to underscore, before we go to the numbers, to underscore that we want to remain in a low inflation regime. Why is that? Because actually high inflation, if we move to a high inflation regime, it will be quite disastrous. Markets don't work well when you have in a high inflation environment. But beyond that, households and farms begin to pay attention to individual prices. So I get concerned about the price of milk or the price of every single commodity. And that in itself leads to sort of additional, let's say, additional channels where then I get to be more worried about my wages, what I'm getting paid, and therefore you may end up having this sort of wage price spiral that will in itself is quite destructive. So it is important to appreciate why it is we in this is not just our central bank, but around the world, the issue of inflation is significant. And it's also important to appreciate that it leads to risks. It creates risks in places that are not so obvious. And consequently, you may end up having significant financial stability issues also popping out of this. But importantly, it affects the weakest members of our society the most. So that's why we, as a central bank, it is actually our mandate number one to deal with inflation. And I think that's one of the reasons why we have been quite clear that we have to deal with inflation and make sure that it doesn't get an anchor. Inflation expectations don't run away. And indeed, we do need to go back to the threshold, to the band that we have in terms of our target. So that's in terms of the background. But the numbers, as was shown on the slide, the most recent numbers are October, and I'm sure you've seen those numbers. 9.6 is the latest number, and 9.6%. And you can see it's been driven largely by food and fuel prices, but largely food. So this is the contribution to overall inflation, and the blue is food. So you can see out of the 9.6 percentage points, 5.7 was really food, and 2.3 is fuel. And as you know, we have been adjusting the price of fuel in terms of, first was the removal of the subsidies, and then following the trajectory of the international prices. So we expect that will continue going forward, that is eliminate whatever subsidies there are that may remain, and continue adjusting the price relative to the international prices. Now, in terms of food, again, this is an interesting chart. It tells us that of 4 commodities only, wheat, milk, maize, and edible oils, these 4 commodities, they contribute 3.1 percentage points of the 9.6 that we mentioned a moment ago. So 4 commodities contribute about a third. That is significant. So you can see, even as you talk food inflation, when we mention that is what is driving the CPI, actually a lot of that is just 3 commodities. And we expect that some of these commodities will follow other cycles, as we have mentioned, wheat, maize, milk, etc. So just wanted to leave that with you. Moving along, okay, now we are moving to the domestic economy, and now talking more about growth. And we know that the first prints of Q2 by the National Bureau of Statistics were circulated some time ago. I'm sure you've seen them. And that is the column that says, that is labeled Q2. Okay, so those are the actuals. So between Q1 and Q2, actually, the growth rate for the first half of 2022 was 6%. And you can see the 5.2 was, in Q2 was actually strong growth. And that's the way we need to appreciate that, to characterize it as a strong growth. The interesting one, I think, is agriculture, which was the one that was dragging the rest of the economy. So actually we have, in terms of growth, you can see it was a decline in Q2 of minus 2.1. We actually had been projecting sort of a stronger growth in this sector. But the other services was obviously very strong, growing at 7.7, and we expect that will remain. And of others, industry also, you can see that was a significant growth at 5.6, and we expect that dynamism will remain. Bottom line is that we expect the annual projection, on an annual basis, that is for 2022, to have the outcome at around 5.6% of GDP. And this is quite strong. Bear in mind that there was the sort of elections in August, and also the pressures from the international sources, as we mentioned before. So all that put together, but we still land on our feet. So it proves the resilience, or it points to the resilience of the Kenyan economy. We've talked about this in the past. A lot of it relates to being highly diversified in terms of the various sectors, etc. So that's what I want to say about the overall growth. But for 2023, we are tentatively projecting a number like 6.1% of GDP. But that is a number that obviously we'll revise as we go forward. Now, let's go through quickly some of the indicators, leading indicators. And this is a sales turnover on wholesale trade. And the one on the right is manufacturing sector. The blue line, the dark blue at the top, is really shows the turnover in terms of Kenya shillings, millions. But I think the growth rates are the green bars. And you can see that has continued strongly, around 10%, you have 15% in the wholesale and retail trade, and then 8% in October, etc., and also on the manufacturing. I think the point here to make is that there is clearly there's a lot of dynamism that is being shown in these numbers, and we expect that will continue. If anything, it will accelerate as we now get into the Christmas season, shopping, etc., and also the back to school in early January or in January. So I think the point here is that clearly this is indication of strong activity that will be sustained. Then the next one is on power consumption. I think we understand what this relates to, and you can see the green bars, that's the growth rates. The blue, dark blue is the levels. But then switching all over to the large power consumption, you can see the same trend is repeated there. August was a low month. I think we all know why. That was the elections. And so a lot of the manufacturers, etc., consumers of electricity had shut down for that period to allow people to go home, etc. And so the consumption was limited. So next slide is on construction. This is cement manufacturer sales turnover. This is a bit puzzling. I'll then show the consumption and production in a minute. This is just sales turnover. And the July, August, you can see the decline May, June, and then July, August, significant decline. And I think the reason here, we had said that it is related to two factors. One is the closing of, the closing off of some large projects, the expressway, etc., that was consuming a lot of cement. But you can see it's picked up in terms of sales turnover. Now, we still have not got to the bottom of this, I have to be honest. Why is that? Because let's look at the next slide. The next slide is on cement consumption and production. So this is in tons, yeah? So you'd expect that this is what relates to what I mentioned before, projects, etc. Now, in the slide we showed a moment ago, there's a pickup in the last 2 months. But here you can see it isn't quite picking up. The growth is not well, the decline is smaller, but I think there's still a decline. So I guess a lot of this also relates to, I mean, between production, consumption, storage, booking of transactions, etc. But anyway, what is clear is that we need to understand this better, but it is something that I think also shows that there is, at least there's a recovery of a kind. Obviously, we are cautious about indicating that this is a recovery from these numbers because we haven't gotten to the bottom of that. Then transport and storage, again, numbers are pretty much the same. Strong activity and accommodation, obviously, is something that we were concerned about. This is your hotels, etc. And I think the numbers are quite favorable. Moving on to the next one, the last slide is on private sector credit. This now, as you know, is at 13.3%, so a gentle growth, which is what we were expecting. And if you look at the sectors, the next slide, just the sort of large sectors, manufacturing, trade, business service, and indeed even consumer durables. You can see there's a lot of dynamism. If you connect credit with economic performance in the private sector, but at least in those specific sectors. Moving along, the next slides are about the CEOs, about the various surveys. As you know, we do 3 surveys. We are now doing 3 surveys. First is the CEO survey, and then the next one is a market perception survey, and the third one is on agricultural sector survey. So I only have one slide, well, I think for the CEO survey, and all that I wanted to show here is that there has been significant or sustained optimism. You can see the totals on the left-hand side, on the right-hand side. So you have companies and about sectors. So you're asking them about the confidence in the company, the prospects of the company, and also prospects of the sector. And looking at the far right, you can see in September, you know, those that were the same or felt that the prospects would be higher were something like 84%. And now you can see that there has been a slight reduction in that, 82%, but I think still quite strong. The reasons are clear, and the CEOs did tell us why is it that why they were optimistic, and obviously the end of elections, and then obviously the settling in of the new government. All those things lead to, you know, stability and indeed, you know, better prospects, etc. The concerns relate to high inflation, stronger US dollar, which has been affecting everybody around the world, as I mentioned, and possible global recession. So you can see we are connected with the rest of the world. Of course, the drought conditions in some parts of the country was a concern, particularly for those CEOs that are connected to the agricultural sector. So not necessarily farming, but it could also be agro manufacturing, etc. The next one is from the Market Perception Survey, and this is something that again points to significant optimism. On the left-hand side, on the right-hand side, you can see this is more for non-banks. This is the respondents were non-banks, and yes, so there has been an increase, or let's say a decrease in their level of optimism from the September, so almost doubling of the level of, let's say, those that are pessimistic or very pessimistic, the gray and the yellow, at the top, from 13% to 24%. And the question was why? And the respondents really pointed to the risks relating to high inflation, high interest rates, high cost of production. That was 60% of the respondents. And then moderation in agricultural performance due to the depressed rains. So the rains were a significant element here. Now, we did this survey at the beginning of the month, the first 2 weeks of the month. And I think that was before the rains kind of got to us, at least here in Nairobi, even though other parts of the country, there has been significant rains for some time. So it may be a timing issue, meaning those that were, they were still seeing very dry conditions, including, I guess, in the newspapers, etc. Moving along, the next one is about the hotel bookings. And this was from the Market Perception Survey. And you can see that they are really strong. You are talking in Mombasa, February, 60+%. And this is forward booking. Yeah. Now, as we all know, a lot of us do our booking sort of last minute or last day or last week. So the way things are now, it is clear that there's a lot of dynamism in that sector. As a matter of fact, already there are places that are completely booked, fully booked. You can compare that to where we were, let's say, earlier in the year, a year ago, November 2021, December, and you can see the sort of forward booking numbers were much lower. So things have stabilized. Mind you, it's not just Mombasa, it's across the board, including the rest of the country, right? Rest of the country at 40% in February, for February 2023. I think that is pretty good. Moving along, this is the agricultural sector survey, and I think there's a lot of material there in this survey, but also in the others. And this one, the only thing maybe the only two things I would want to put out here. First is the respondents expect to have an increase in output in the next harvest relative to the last harvest that they had. The only one that obviously is a bit of a concern there is tomatoes and onions. For those of you that are into kachumbari, well, you are so warned. So tomatoes and onions. But the others, as you can see, there's an increase, and pretty much increase or remains the same. We can talk a bit more about the details, but I think I should at least say that we expect the ongoing rains will boost the fast-growing crops, mainly vegetables, and but we also know that a lot of rain will affect negatively production of tomatoes, so there's that concern. Moving along, the next one is about the problems in the agricultural sector as reported by the respondents. And all I want to say is transport costs, input prices, and weather conditions account for significant factors at least from the perspective of the respondents, that need to be dealt with. Please look forward to the surveys, which will be published by tomorrow midday, 12 o'clock. We should put those on our website. Thank you very much on that. Let's move on now to the balance of payments. And the balance of payments, I think, have been quite strong, favorable. The goods exports, that's merchandise, they remain strong. Grew in the 12 months to September, relative to the 12 months to September last year by 13.9%. And I think we expect to see similar growth for the end of the year, that is for the year 2022. I think this is a good slide. You can see tea has been quite strong. And there's a question about horticulture, and we'll talk about that in a minute, but most exports have been quite strong. The average price on tea, let's talk about tea, you can see has, compared to last year, have been stronger. And I think this is what is coming through in terms of the outcomes. The next slide is on horticultural exports. Horticultural exports, there are two items that I think are worth flagging. One is the cut flowers, that's a deep green. And there has been a decline in that. And actually here we are not sure, we haven't really tied the bow of this. We haven't tied all the loose ends. So we have some partial understanding what's going on. But I think the point here is that it has stagnated, at least compared to where we were before, and we are not sure if it is a production issue entirely, or it is actually just a demand issue from the countries. I think there's a potential, let's say, both issues. So this is something that I don't want to speak too much about because we haven't tied the bow, as it were. But on the fruits, the big one there was avocados. That is the decline as a source of decline. We've talked about that before. But as you can see now, it's picking up in Q2, well, more like Q3. Because we now have, let's say, ready markets, we are exporting those fruits to China and I believe India as well. So there's a lot more potential in that regard. So now moving on to imports. And on imports, I think here is simple. It has increased, imports have increased by 18%. But really, what has driven this is oil. Oil imports. That increase, as you can see, from 2.9, actually 3 billion US dollars import for the 12 months to September. That is 2021, and then to September 2022, it is 5.4 billion. So actually, if you, in a sense, just looked at everything else except oil, all other imports except oil, actually, oil imports would have, it would have, all other imports except oil would have grown by 5.5%. 5.5%. And you can see that is not quite keeping up with, well, rather it is keeping up with the real economy. You know, we talked about growth of 5.6, etc. So it would be aligned to that. So I think the point to make that on the oil imports, on the import side, the only significant item to sort of keep track of is oil. Here is one that shows the production, rather the imports by type, consumer, capital, intermediate. Pretty strong growth in intermediate products, so that relates to manufacturing, etc. And indeed also consumer output, consumer durables and other things, or consumer imports, which we expect to see, and also expect to see a slight increase as we come to the end of the year, because the imports should have come in November, early December, for us to buy whatever it is that we are going to buy around Christmas. So that's what I would want to say about the imports, but there are other things to mention about the balance of payments. Services exports, a lot of this is travel and also transport receipts growing strongly. I don't want to say too much. That's a very busy chart. This is an even worse chart, I think, in terms of presentation, but there it is. Tourist arrivals, probably the way to think of it is the dark blue in the, that is right there in the middle, is chasing the light blue. The light blue is from 2019, which was sort of like the best year that we had then. So it's going to that. It's already overtaken the 2021 performance. But I think the point here is that we are going back to where sort of like the strong performance of yesteryear, you know, of previous years in terms of arrivals, etc. Diaspora remittances remain strong. And this is something that we expect will be quite strong to the end of the year. As a matter of fact, now we expect to see the strongest inflows as we come to the end of the year. December is always a very strong month, and November depends on many things, timing, etc. But whatever will happen, the inflows in November and December taken together will be quite strong, or we expect those to be strong. Okay, moving along, current account has been, we have re-estimated the current account deficit at 5.6% for the year for the year 2022. And that is down from 5.9 that we had before. By the way, for the 12 months to September, it's 5.3% of GDP. And I think that is, we've made this point again and again that our sweet spot for the current account is around 5%. So we are in that range. We are within the range, as it were. Then exchange rate, you have the standard charts. I'm not going to talk too much about this, just to say that our currency has depreciated by 8%. And the US dollar is the one that has been driving everyone else. This is the index there is, again, relative to the major currencies. It was up to 14, 18%, and now it's down to 12. Actually, it's come down the last 2 weeks. But it's still 12% over all the other currencies. And then looking at our local currencies, we are at 8%. And you can see where the other currencies are. Various levels. But I think we've made the point again that we want to be sort of in the middle. I mean, we are okay, you know. Even as we know that there's a lot happening, I want to underscore again our exchange rate policy. And our exchange rate policy remains that we have a flexible exchange rate regime, and we intervene only to minimize volatility. So our exchange rate policy has served us well through the crisis, not just this one, but all of them, the plural of all the crises that we've gone through. And it has served us well as an automatic stabilizer, adjusting more quickly before other policies can be put in place. So I think we are comfortable with the outcome of that set of policies. Now, this is the exchange rate cover, foreign exchange cover. So the question here is, okay, the central bank holds reserves for quote-unquote rainy day. And, obviously we use the reserves to make payments for the government. And also it serves as that sort of fund, rainy day fund, as it were. Now, it has come down to almost 7 billion US dollars from a peak of almost 9 billion a couple of years ago. And I think in terms of percentage of, or rather months of import cover, as was indicated in the press release, this was 3.94 months of import cover. Now, I need to make a couple of points there. So it is, what really is the policy? What are we shooting at here? And I think I'll make 2 points. First is, according to our act, at all times, we are supposed to at all times use our best endeavors to maintain a reserve of external assets at an aggregate amount of not less than the value of 4 months of import cover, calculated in a particular way. Now, it's interesting that the numbers we are giving you here are not exactly this. I need to make that point. Actually, the numbers that we are giving you relate to usable foreign exchange reserves. So in that sense, it's not just the assets. It is assets net of some liabilities. So you can imagine that it is lower than where really the external assets themselves, which are not netted, you haven't netted out anything, would be. So we do understand that difference. And we had indicated before that there's about there's a margin there because we do have some liabilities that we need to net out. So from our perspective in the central bank, we've always wanted to have something, meaning to watch. Think of your dashboard. You are looking at something that, that will give you warning, etc. That is meaningful. And from our perspective, this is why we have been monitoring that usable foreign exchange reserves rather than just looking at external assets. Although actually the bank, the CBK Act, and indeed also the EAC Monetary Policy Protocol, Monetary Union Protocol, talks only about external assets. Now, there's also that word best endeavors, and we have to appreciate best endeavors. It means that we have to do what we can to make sure that that happens. And therefore, that means that occasionally there may be moments when the number is, even with your best endeavors, the number may be lower than the target. And so the best endeavors from our perspective today has meant 2 things. One is we've looked ahead, we've looked forward, and we expect some inflows to come in. So we are not waiting, in a sense, we are projecting inflows, some of which I can tell you. IMF disbursements at the conclusion of the review, which we expect will be completed sometime in December, and that would allow a disbursement of about 440 million, the equivalent of 440 million US dollars, so something like that. Then there'll be others later in the year from the World Bank, large amounts, relatively, maybe not relatively large, but 400 million at this moment can increase all the way to even 1 billion. There are also other IMF transactions or disbursement that will take place by June of next year. So there is actually programmed inflows, and that gives us comfort that we are doing our best endeavors in this regard. In terms of the payments, a lot of this is virtually payments for government debt, and those are programmed. So we need to make sure that those are paid, and so that's how let's say the best endeavors equation is put together. Moving along, I want to make a few points on the and I'm now conscious that I've been talking for too long, so maybe I should bring this to a close very quickly to allow you time for questions. So I'll only make then 2 points about banks. Their liquidity levels and capital levels remain okay, adequate, and we made that point in the press release. But I think the 2 developments that have happened recently, first is in the credit information sharing framework, and this is something that obviously there has been concern from various members of the public and everyone else that this could be improved, and we tightened it. We've been working with the CRBs, that's the bureaus, the credit reference bureaus, and also the banks, because it works both ways. So first, in terms of making sure that the records are correct, and that is something that we've been working with the CRBs, make sure that their algorithms for calculating credit scores, world class, etc. So that is an ongoing sort of work program, but I think that's going well. Secondly, the issue of making sure that your credit score is not the only thing that is used for your in determining whether you be given credit or lending, etc. And now, if you would look at your own credit report, at the top of the credit report, it is quite clear. It says that this in the information, the credit score is it should be used in addition to others. It's not the only issue. The only let's say it shouldn't be used only on its own for making a judgment on lending, etc. Then we've also worked with the commercial banks to make sure that they actually understand this and are tightening, let's say, their risk-based pricing. Remember, this is a journey we've been on, because really the two work together. So if they are looking at the risk-based pricing, they'll look at the potential borrower and understand risk as how risky is that person, based on a variety of information, of which the credit score is one of them. Then there was so I think that we've made significant progress, but again, to understand that this is a journey, and it will in the end be beneficial for all of us, because at the end of it, we need to have borrowers benefit from their history of good payments. So it is important to appreciate that it is not all negative. There's the positive side, which we should distinguish those that are good borrowers and those that are not so good borrowers. And therefore, the person who borrows, who repays as per schedule, would generally get a better terms for their future borrowing, etc. Then the last point I wanted to mention is on the credit repair framework that we approved recently. We talked about it, I think. But I think the point here is that this relates to borrowers that had borrowed on the digital platforms, right? So these are sort of the digital lenders on the Mshwaris, the Fulizas, etc. And really there were about, well, maybe to put it differently, the idea here is to work with the borrower to repair their credit record. And so the banks have, let's say, subscribed to this credit repair framework and have communicated to each of their borrowers, and indicate those specific borrowers, indicating that there will be a 50% waiver on whatever is outstanding, and then a 6-month program, or it could be sooner. The program has to be within 6 months of by May 30th next year, and being given an opportunity to actually have repair their credit score and indeed their credit, well, also their credit history in this regard. Having said that, just to throw a few numbers at you, in total there are about 19 million unique borrowers with CRB records, right? So 19 million unique borrowers. There are 3 CRBs, and my information could be in all 3 of them for the same loan. So it's important to sort of figure out, how many people are there? And we are making the point that there are 9 million unique borrowers with CRB records. So that's the universe, right? From which the credit score is calculated. Out of this universe, 12 million unique borrowers have records of performing loans. And this is, let's say, until, this was before we started this credit repair mechanism. So there are 12 million. And then the balance, the 7 million, have records of non-performing loans. So you have a loan that is non-performing in there. And this includes 4.2 million with non-performing mobile phone digital loans. And that will be worked out through the credit repair framework. So those are the big numbers. And I think it is something that we are happy with. There are those of you that are concerned about the impact on IFRS 9, etc. And the point is, yes, it has nothing to do with IFRS 9. IFRS 9 remains the same. And banks will remain completely compliant with IFRS 9. And this only relates to the other side, which is reporting to CRBs. I'll stop there, and I'm conscious that I took a lot longer than I intended to speak. So I'm ready for your questions.
Thank you. That was the Governor of the Central Bank, Dr. Patrick Njoroge. And we'll jump straight into the questions. We begin with Julian Zamboko of NTV. Julian's question is, with foreign exchange reserves at 3.9 months of import cover, breaching the recommended floor, does CBK still have buffers to smooth out volatility? The next two questions come from Kefa Moirore of Radio Citizen. The first one is, how does the CBK see lower interest rates as desired by government, which is 10% on treasury yields, panning out amidst the current environment, which is high inflation and high rates? The second question from Kefa, how would the Central Bank of Kenya assess the effect of the previous 2 rate hikes on the economy, given both the continued rise of inflation and a weaker exchange rate?
Okay, thank you very much. So the first question on the 3.9, I think I explained this. And Julian's, you should also appreciate that it's not like a trap. You know, when you get there, you're caught. Meaning it's not, things are not, it's not like an accident, right? The moment you are below a certain number, stuff happens, whatever that is. So, and this is why I spent a bit of time explaining that, so if you have 4.1 and 3.9, are they really different? No, absolutely not. But in terms of calculation, they are different. So this is where maybe we all understand when somebody tells you, okay, fine, what is this number? Divide X by Y. And then you are given, I don't know, a number in 3 or 4 or 5 decimal places. It doesn't make sense to do it that way. So what point am I making? We still believe that we have adequate cover to smooth out any volatilities that would come. We also know, as I said, we are doing our best endeavors to ensure that we get reserves, and this is why we are not stressed, as it were. And so in terms of the CBK continuing to perform its function in the markets and elsewhere, also the function of payment of, for government external payments, etc. Oh yes, we are very clear, we have absolutely no problem continuing with that at 100%. Then the question about lower interest rates as desired by government according to KEFA. How does that sit against the environment of high inflation, etc.? Maybe to take both questions together, also the question about the previous rates, how do we assess that? I think the point here is that we all desire a lower interest rate environment. That is clear. But I think we also have to prioritize things. I spent a bit of time explaining the dangers of high inflation. So, and also explaining the dangers of high inflation. So the first order of business is to deal with inflation. And then the others will get to, yeah? So once we have inflation, interest rates will come down. And in a sense, the lower interest rate regime is sort of like in the near term, right? Or medium term, in the future. And we'll get there. But the macro balances that need to be there in the economy, that is essential. So let's deal with the most urgent problem, and then we'll get to the others. And I think that's really the approach that we have taken. And that is, and all these many years we've been taking that approach, and you can see the benefit of it. You have already seen the declines of interest rates from the very high levels that that were there, let's say in 2015, 2016, and even subsequently, and to then more normal levels. Are we saying that the current levels are the ones that will stay forever? Of course not. We want to even go lower than this. But again, inflation was unexpected because of all these external pressures and food, etc. And so we have to take action to deal with that and realize that it temporarily goes in the wrong direction if one is desiring to have a lower regime. But I think this is where you need to, let's say, 2 steps back before jumping, right? So I hope that makes sense. In terms of the assessment of the hikes, we did this, and all I can say is KEFA is talking of the recent adjustments in May and September, and the impact of that is sloshing through the system. Yeah, it is still, let's say, as I said, it takes about 60 days, 90 days to really create, to sort of get, let's say, some impact on lending and the rest of the economy, sort of the interest rate sensitive components of aggregate demand.
The next batch of questions, we begin with David Herbling. David Herbling is from Bloomberg News. Do you think Kenya's inflation has peaked, or do you still see prices rallying? Julian Zamboko from NTV, does the CBK have any plans to reverse the CRR cut, that's a cash reserve ratio cut, effected in April 2020? And Herald the Law of the People Daily, the Central Bank of Kenya ordered the delisting of about 4.2 million borrowers, yet most digital lenders have not been cleared. Are you not concerned about this?
Okay, so the first question, I don't know. I mean, whether it has peaked or not. I don't think the point for me is to sort of come out with a point estimate. Yeah. So we are not doing point estimates. What is clear is there has been inflationary momentum, and we need to turn it. So whether we have completely turned it, or whether there'll be an additional sort of, let's say, month or two where it hasn't fully turned, that many factors. We talked also about food as one of the key drivers. And that is, your guess is as good as mine. We've done the survey, etc. But does that mean that we are very, let's say, sure? Yeah, how comfortable are we? How firm are we that the price of maize, the price of milk, the price of wheat, yeah, the price of edible oil, the 4 commodities I mentioned, will actually be turning, meaning coming down and not continue to increase or remain flat? So in that sense, turning points are the most difficult things in economics to predict, and therefore we are not going into that sort of let's say fool's errand of making predictions on things that, in our view, it doesn't matter. What is clear is we are addressing the momentum, inflationary momentum that is there, and the policies that were put there we believe are appropriate, and consequently we would expect the prices to begin to come down in the near future, or rather inflation, not prices, inflation to begin to come, the inflation outcomes to begin to come down, and hopefully in the next quarter, sometime the next quarter, early next year, we would see the outcomes back in the target band. Julian's asked about the CRR cutting and reversing this. No, we haven't. I think the Monetary Policy Committee has taken appropriate actions, knowing that that number is out there. where the CRR was adjusted to. So at this moment, those policies are sufficient, and we don't see a need today to have additional policies. If we needed additional policies, we would have put them in place, and that was not the case. And Herod's question, I don't know, Herod. You're telling me that yet most digital lenders have not been cleared. I don't know what that means. So I just explained how the numbers stack up. And if indeed you had a loan to a digital lender, Herod, let's do this. Why don't we, Wallace will send you 100 shillings, and you will go into your CRB and look for your record to see where you are. My point is that if indeed you had a digital loan, Fuliza or any of those things, they are part of it. They must have contacted you by now to tell you this is the situation. Now, the only problem is you may have had other loans that you probably were also having, were not performing. Obviously, that you have to deal with. So let's be clear where the facts are. And the facts are, as I explained them, and of all the ones that have digital loans that I mentioned, by now they should have received a message from their, let's say, their lender. And if not, then get in touch with them. Get in touch with them. So let's leave it there, because I think there's a bit of misconception here, and I don't know where the misconceptions are. And Harold, maybe Wallace will send you 100 shillings, and then you tell me what your credit report looks like.
So 100 shillings promise has been made. The final question is from Martin Mwita from the Star. And Martin is asking, with yet another Fed rate hike, I assume that's a Federal Reserve in the United States, another Fed rate hike expected in December, where does this leave the shilling amid the continued high demand by importers?
Okay, Mwita, I guess there are two things here. Let's understand how the hikes or the increases in interest rates by the advanced economies, central banks, in this case the Fed, how is it affecting us? Maybe the channels that you're mentioning may not be the ones that this is coming through. But I think the point here is that increases in interest rates in the US, what it was doing is it was attracting, let's say, a lot of capital into the US market. And as a matter of fact, it was the US market because there was also a differential pace between the ECB and also the Bank of England was more or less on track. But anyway, ECB and the Fed. So that is really, so the action was taking place in the financial markets, right? That's basically it. And we are actually not so connected with those markets directly, meaning we don't have, we are not like the Canadian dollar or the UK pound, etc. So the point here about the pressure on the shilling, it's really on everything else, right? So in a sense, it's where everybody else is dropping because the US dollar is pushing everybody down. So it's going up, everybody else is going down. So that, of course, mutatis mutandi, there are some things that obviously I'll skip in this sort of stylized sort of description. The point here, though, is that all that for now, it is clear what, for the most part, actors have incorporated those sort of decisions into their actions. So in some sense, you have, there's a sort of expectation of that already happening. It's not a surprise. It is the surprise elements that drive markets a lot more. This is why the US inflation outcome was a bit of a surprise, and therefore it drove markets, because everybody felt that the US will have to be less aggressive than it had stated it would be. So I don't think there is, at least in the short term, we remain where we are, where we were, meaning in a corner with all other EMs in emerging market and frontier economies. So I don't see that as being a new piece of information that will drive the markets. What will drive the markets is something else, which is maybe a new piece of, a surprise piece of information. I didn't mention this, but I think I should have, which is to insist on the number one problem of, as we see it today, which is the danger for a financial accident. And we are talking of a financial accident in the emerging market space, or for that matter, the markets as we saw them in the advanced markets, let's say, the financial markets. You know, think of what happened with the cryptocurrency world, yeah? And yeah, sure, that was an accident. Maybe people should have foreseen it, etc. But you can imagine having, you know, this is still a small piece of the entire financial sector, and actually not connected to the more traditional parts of the financial sector. So the point I'm making is having an explosion of just one, or implosion of one particular entity can have significant shockwaves that would be felt not just in that market, but in all markets, and indeed much further out. So that is sort of like the number one concern that keeps most of us awake at night. So just wanted to throw that at you. Thank you very much.
Thank you, Governor. That brings us to the end of this press briefing. And as is usual, we do these press briefings after every Monetary Policy Committee meeting. So we expect the next one after the next scheduled Monetary Policy Committee meeting in January. But as a press release says, if there's any need for the MPC to meet earlier, that will be communicated. But for now, thank you so very much. And if we do not see you again, do have yourselves happy holidays and a happy new year, and see you when we see you.